We all feel something about everything and everyone around us at all times. This emotion is what makes us human. Talking about emotions, the most commonly cited emotion in psychology second to love is regret. We experience regret all the time, and this feeling of regret is stronger when the stakes are higher. Lately, we see a lot of work around behavioral finance or behavioral economics, where psychology meets finance. It's studying finance from a people's lens. Because ultimately, it's people making decisions which bring human emotions into the picture, and that changes everything.
In psychology, there has been a lot of work on regret. So there are theoretical models taking into account how people might behave when they feel regret, right? There's also a lot of experimental evidence that kind of induces regret in a laboratory setting and observes how people will behave, right? But none of these are in a real world setting, right? Either they are theoretical or experimental in a lab. So what we bring to the regret research is a real world setting.
This paper explores if we can systematically investigate regret in people's life and its effect on their future decision making. We specifically focus on individual investors in a stock market.
Regret theory tells us, and intuitively also we can imagine, that if somebody feels regret, then if they are in the same situation again, they will behave differently. Essentially, they will change their decision, right? So this is our basic hypothesis.
With the hypothesis set, to measure regret, we need to know two things. 1. The alternative choices one had while making a decision. 2. The result or outcome of those alternative choices. So comparing the outcomes of the choice one makes with the outcomes of the ones they don't helps quantify regret. And this was analyzed in the context of the Shanghai Stock Exchange.
Given our data set is like more than 100 million transactions across different individual investors, what we were trying to look at is what type of orders these individuals are submitting. Specifically, what we look at is two types of orders that investors can place. One is a market order, where you place the order to, let's say, buy a stock, and you definitely will buy it at whatever is the price at that time. The second type of order is a limit order, where, let's say, again for buying, then you wait a little bit and see if you can buy that stock at a cheaper price. Right? Here there's uncertainty that you may not be able to buy at all. But if you are able to buy, you will buy it at a cheaper price. Right? So these two types of orders is what we compare. Suppose an investor placed a market order really, and then the stock went up till the end of the day, then there's a positive return from the actual decision, right? But let's say the investor would have placed a limit order, and that limit order would have not been executed, right? Then the investors kind of missed out on this price rise of the stock, and then there would be a regret. And that is essentially how we measure regret. So the difference between what actually happened and what could have happened.
And what they found was that if an investor who placed a market order experiences this regret, then next time they are more likely to place the other type of order, that is the limit order, and vice versa.
In a real world setting, examining if regret really plays a systematic role in people's decision making, right? So the answer to that question is yes, it does. But what we do find is that decisions that are affected by regret actually turn out to be worse decisions. Okay? And investors actually lose money the more they change their decisions because of regret.
Overall, investors change their decisions about 33% of times. And when the regret they feel is equivalent to losing 1% of returns, they are likely to change their decision by an additional 3.5% points, from 33% to 36.5%.
Even though intuitively we know that regret is very important for people, to study it systematically is difficult because nobody other than yourself typically knows what the other decisions that you did not make could have been, right? And that's why this is a very interesting setting. Because of this data set, we are able to figure out what could have been the other trading decision and then compare the outcome of the actual decision and the hypothetical decision that was not taken. The findings that come out of this research are relevant for investors making their own decisions. They are relevant for asset managers who are managing money, like mutual funds or other alternative investment funds, who are managing money on behalf of people. Again, regulators can look at this to say whether investor protection needs to be strengthened in some way, and so on. And students of finance can learn from this to trade and or check their own financial markets decisions.
Looking at a bigger picture, we don't need to regret all our decisions that go wrong. Like when the usual route to the office has too much traffic, we switch to a different one. This decision is through learning from an experience. So it's important to separate regret from learning.
And it's a mental exercise, because what we find is that that part of decision which is induced by regret, that is the one that leads to bad outcome. So in real life also, it is kind of useful to separate out, is there some learning? Then yes, you must retain that. But is it a knee-jerk reaction to just things going badly? Then you should not act on that.